Welcome to today's webinar entitled Solving Your Retirement Puzzle. Hi, my name is Keith Matthews. I'm the Managing Director of Tulett Matthews & Associates. I'm a portfolio manager and I'm the author of The Empowered Investor. Thank you again for joining us. We're thrilled. We're going to be reviewing a framework, introducing you to a framework called the Retirement Puzzle. It's going to help bring tremendous clarity to anybody who is at this step. And this is an individual that could be in their early to late 40s, could be in their 50s, early 60s, anybody who's got questions about their retirement, anybody who wants to improve the clarity around what retirement might look like. And so most of the individuals we see in those age categories, they've got two main questions. Question one, will I have a financially secure retirement? In essence, they're asking the question, will I be okay? And so for serious pre-retirees, there's two main things that most of them want to know. A, they want to know, am I on track? Have I done everything that's required to make sure that I have a secure retirement? Number two, they want to know if I'm not on track. This is very important. If I'm not on track, what do I need to do now to ensure that I will be okay in the future? And so this is what we see most individuals yearning for or wanting to do when it comes to them thinking about their future and their retirement. So what we've done, what we've used is this idea of a retirement puzzle. It's intuitive, we think it's fun for individuals, and it's a great way to get clarity around your financial affairs. Why this retirement puzzle? Again, as I mentioned, it makes retirement planning clear and easy to understand. It makes the process of putting it all together way more intuitive. We all might have grown up putting puzzles together. It's the same thing. We're going to review your like a fingerprint, your unique retirement puzzle. We're going to identify the pieces. I'm going to put it together. It's a fun way, it's dynamic, and it's a great exercise for all pre-retirees to do. Finally, it brings solutions and answers and peace of mind around your retirement projections and what your retirement might look like. So again, there's two main things we're trying to solve in this. If I'm on track, fantastic. What can I do in addition if I am on track? Other extra spending? Is there extra things that I could do from a gifting perspective? We'll be able to identify it. You'll be able to learn all about this. If you're not on track, we're trying to identify what you could do to adjust so that you can get on track and have the retirement you'd like to have. So there's 3 steps to solving your retirement puzzle. Step number 1 is we want to introduce you to the retirement puzzle framework. So you need to be aware that there's a framework. Step number 2, you need to identify your personal pieces of the puzzle. Step number 3, we're going to take those personal pieces of the puzzle and we're going to put it into projection to give us a view, to give you some clarity. So those are the 3 steps. So let's jump right in and go over each of them. Step number 1. Step number 1 is understanding that there's a framework. And the framework has a whole series of items that you need to look up. The first is retirement spending. We'll go over that in a little bit more detail soon, but that's a critical component to understanding your framework. The second part is retirement income sources. Where are you going to get your income from? The third is you need to evaluate your fixed assets and possible inheritances. The fourth is you need to understand what assumptions to use for either investing or planning. Fifth one, is we need to go through stress testing. What if scenarios? So why 6? Because the last one, the 6th one, is this really needs to be reviewed and adjusted every few years. So there's the framework. 1, 2, 3, 4, 5, and then a review process. Let's jump right into each of the levels right now. Retirement spending. Retirement spending is by far the most important. Well, not by far. It's a critical component, and we've broken it down into 3 sections. So each and every person has the go-go years, what we call the slow-go years, and the no-go years. Now, let's not get discouraged with words like slow-go and no-go. retirement can be a phenomenal time in each of these stages, but there are different spending patterns associated with each stage, and it's important to understand them and to be aware of them, because each one of these pieces is a piece of your puzzle. The next area to look at is retirement income. There's lots of different components of the retirement income. These are pieces of the puzzle. We've got QPP if you're in Quebec, CPP if you're outside of Quebec, OAS. Individuals may or may not have a defined pension. Most individuals have some form of savings, whether it's in a sheltered program or a tax-free saving account program, whether it's a non-registered investments. And then finally, every single person will have some form of the savings rate, how much they're saving on an annual basis. All these things need to be looked at, and each one of these is part of your retirement puzzle pieces. Third level, we need to review all of your fixed assets. Most individuals will have some form of fixed assets, whether that be a home, a cottage, investment property. For business owners, by far their number one asset tends to be the business. And then finally, many Canadians will receive some form of inheritance. I know that they don't like to necessarily add that in the retirement projection, but we think it's relevant to at least be aware of and include as one of your pieces of the puzzle. The next level would be your assumptions. We want to go through, and each one of these assumptions is a part of a building block, or part of a piece of a puzzle. There's asset return assumptions. There's your asset allocation or the changes of asset allocations during your retirement. There's the fees associated with the management of your portfolio. There's inflation and taxes, and then there's what-if scenarios. So all these are pieces of the puzzle, and every person has a very unique set of pieces here. Finally, there's the stress testing component. There's three pieces of this puzzle. It's the stress testing component. There's the longevity risk, market risk, and sequence of return risk. We need to be aware that they exist, and they are, again, a piece of a puzzle. So, if I look at this, we mentioned this at the beginning. Each individual has a unique fingerprint. Each individual has a unique puzzle. And this is this idea of understanding what that puzzle looks like for you, and then putting that into a projection system. So if I look at this as the total puzzle, what I mean by unique is we'll realize that some individuals will have different components here. So business owners will definitely have this component. Somebody who has a defined pension plan will definitely have this component, but not all Canadians have defined pension plans. And so most individuals will have, for sure, the three different levels of spending: go, slow go, no go. And then everything else has to be custom fit depending on your unique scenario. But this process of looking at this puzzle and trying to figure out which pieces you own or which pieces you have is critical in this exercise. The second really important thing in this exercise is now determining a cost or a value associated with each of these puzzle pieces. So when I say cost, really that's your spending. We're going to go into that in a second, but we need to calculate as accurately as possible some form of spending in each of these stages. The next area is value. Each one of these pieces has a value associated with it. We need to identify what those values are, quantify it, and they're about to be put into the projection. The last two rows down below are assumptions, and those have to be done correctly. So each individual will have their own unique, not necessarily different assumptions, because stock assumptions should be the same for everybody, but they may have a unique asset allocation. They may have a unique tax situation. They may have different investment vehicles which have different fees that really should be embedded into the program. So, and definitely they will have different what-if scenarios. So again, this entire piece here is the puzzle, and everybody's got a unique puzzle. And then we're going to go into solving with the projection. So you then take all the pieces of your puzzle and essentially you put them into a projection. And there's lots of software out there used by various different financial advisory firms. There's some do-it-yourself on the internet, but essentially these systems allow you to make projections about what things will look like in the future if you include all these pieces. We're going to take a pause here, and we're going to go into probably one of the most challenging things that most pre-retirees have, which is how do you figure out your retirement spending? So if I go back, remember that's section stage number 1 of the framework. So we're going to take some time and dedicate to figure out how we do this together. So now we're going to go into much greater detail about each of these different stages. Essentially, there's the go-go, slow-go, no-go. Obviously, the go-go, there's more activity, there's more spending. And so this is what we're going to try to quantify. Typically, we see this, I would say, between the age of 65 and 70, 75. If an individual is healthy, they might be able to get it to 80. Essentially, this is where there is the most amount of activity, the most amount of hobbies, the most amount of traveling, the most amount of expenses. And typically, you've got some of the classic lifestyle expenses that everybody has in all the ages, all the categories: food, utilities, dining, hobbies, car. You may go from 2 cars to 1 car. This is worth noting. In the go-go years, you definitely have more travel, for sure. You definitely have potentially more gifting. We see it more so today, whereas individuals wish to help support adult children. There could be weddings to pay for. There's a variety of different things, which means in this particular area here, there's going to be a little bit extra spending. So the slow go tends to have a lot of the first batch, the lifestyle spending, tends to have less in the travel and tends to have less in financial support of adult children. And then finally, the last area is the no-go, and that tends to be a little bit more health related. There's some uncertainty here in terms of what you might want to assume, but what we like to do is put some baseline assumptions in, and typically that might mean a bit more spending in the later stages between anywhere 85 and 90, 95. We've got a live case that we'll talk about at the end of this webinar, and we'll expose all 3 of these areas as we go through the projection. So this is great. We've got these different buckets, but it still doesn't answer how you actually calculate. And this is one of the biggest challenges that most individuals have. So you're 55, you're 60, and you're trying to figure out what my retirement spending might look like. And so this is great. We've laid out the 3 major stages, but it doesn't really solve how do you calculate for stage 1. And this is a fairly large challenge for many individuals. You could be 45, 50, 55. And when we ask the question, well, what do you think you need to spend during your go-go years? Sometimes there's a pause and individuals don't quite know. So the exercise we use with individuals is a simple one. We say, let's start with now. Where are you now? What do you spend now? And we ask individuals, go through kind of a budget and figure out what your spending looks like. So that would be the now, current spending rate. You go down item by item and you figure out what you spend today. You then say to yourself, okay, imagine you're retired tomorrow. What will you stop spending money on? Again, this goes back to maybe as a couple, you decide to go from 2 cars to 1 car. Or you may choose to say, no, we're going to travel more, so this is going to be a new expense is now coming in. Regardless, you then have to say, what will you spend in the future? So you do this line by line, and you go all the way down every single line item. And this is really the best way to start. Once you've calculated your start base rate, you can then start adding in the extras for the go-go years. And this is the starting point, which provides clarity around overall spending, because that overall spending now needs to be added into what essentially is going to be the projection, but you're going to put 35 years of spending in. So you'll notice here, I think I've read it out, the first part. We're at 65, we go all the way down to 95. We have to somehow accurately put spending levels in for 35 years or 30 years. And so we've just given you sort of some guidelines as to how to think about the 3 main sections and how to then delve into each of the sections. The second thing you need to do in a financial projection is you then look at all your income sources. And then you need to take all your income sources and attach a rate of return to it, or make sure it's reflected correctly in the projection. So here are the income sources. We've added them in here. Pensions, typically, if you have a pension, pensions are here. There's either an inflation adjustment or no inflation adjustment, but it typically lasts throughout your entire retirement. CPP, OAS, all of the other investment assets, RSP, tax-free saving account, non-registered, all these here would have a rate of return associated with each one, but that has to be into the projections. Next thing we do, puzzle pieces. We go back to fixed assets and understand what fixed assets we have and attach a growth to each of those fixed assets. So here we would go in and we would add the fixed assets, business and real estate. And we would just attach a rate of return, put that in the projection. So once you essentially get your expenses as accurately as possible in the system, your assets as accurately as possible in the system, you then hit project, go, and you try to find out what the results are. And typically what you want is you want some form of assets to be left over at the very end of the entire projection. So success would be having dollars left over after 30, 35 years. Again, we've noted that as success. What does that provide? It provides individuals options. So you get a chance to, first of all, have the peace of mind that you are on track to have a comfortable retirement. Secondly, it's going to give you the opportunity to have choices. Choices to either increase spending, for example, in the go-go years, increase gifting to family members, increase gifting to charities. It gives you a variety of different choices. And so that's the good news for anybody who goes through this exercise and has success right away with their pieces of the puzzle. And what happens if you do the exercise and, like many Canadians, you find out there's still work needed because you don't necessarily get to the end with extra surplus? Well, this extra work essentially can be put into a variety of categories, and there's levers that every single person has at their disposal. Lever number one, we'll go through these. Lever number one is reduce spending. These are obvious, these are classics. Lever number two, increase your current savings. So pre-retirees, ramp up your savings to build the nest egg to where it needs to be. Lever number three, delay your retirement date. Continue to work for a few extra years. And this is the one we're going to show you in a case study because it's one of the most powerful ones. Lever number four, work part-time during your go-go years. That's one of the greatest ways to provide some extra income at a time where you wish to do some extra spending. So there's a nice match for many individuals. Or finally, the combination of a few of the above. Then you put them in, you adjust your numbers, you adjust your puzzle numbers, you adjust the pieces, you redo the projection, and you see if it works. And it's an iterative process. You're able to determine how to make the puzzle, how to solve the puzzle. So let's look at a case study with Albert and Susanna. They're in their late 50s, and they wish to retire at 60. What we've done is we've asked them, and they've modeled out together, we've modeled a spending pattern that looks like this. Lifestyle spending of $76,000 in today's dollars after tax for all lifestyle. $15,000 a year for vacation in their go-go years. $8,000 vacation in their slow-go years. They're slowing expenses. That makes total sense. And $2,000 after 86 in their no-go years where they're not traveling as much. We've assumed they have a home value of $1 million. We've assumed 1% for maintenance on a home value. Many Canadians underestimate this, so they realize that as they start retiring, they actually need to maintain the asset. They need to spend money to keep it up. And so we just build these into projections. Other things that, in this case, Albert and Susanna would like to do. They'll have 2 weddings at the age of 66 for 2 of their kids at $20,000 each. They will shift and sell their home at 80, start renting from 81 to 90. The rent will be $3,000 a month. We'll adjust that into the projection. And then finally, there will be assisted living between the ages of 90 and 95 at $5,000 a month each. This is a tricky one because there's a variety of different assisted living environments with different costs associated. And it's important, if you want to model this in, to make sure that you're using realistic numbers. Retirement incomes are going to come from a few sources. Albert has access to 100% of his Canada pension or Quebec pension plan and 100% of his OAS. Susanna has access to 57% of her QPP, CPP, and OAS at 100% OAS. 57%. She was raising kids for the first few years that didn't have the opportunity to make some of those contributions. They each have $750,000 of RRSP savings. So this is a scenario with $1.5 million of RRSP savings. As for assumptions, we're using inflation at 2% throughout the entire projection. We're doing an asset mix of 70% diversified stocks, 30% fixed income, up to 80%, which gives a net return after fees of 4.35%. And then we're using a 60-40, 60 diversified stock, 40 fixed income from 80 to 95. Now, there's a variety of different asset mixes you could put in a projection. Please, whatever you do, make sure that they are accurate and reasonable in terms of rates of return. So that is the case scenario. Now we put this all into a projection. You can see essentially some of the key parts. We use a system called snap projections. We think it's an incredible way of viewing the entire file right in front of an individual. So in this particular case, we've noted their lifestyle spending, the vacation dollars, and the home maintenance. You can see we actually highlight them, or they're noted as columns. We think this is critical because what it does is it highlights these different spending levels. And with the highlight, you become aware that these categories exist, and you want to make sure that they're accurately completed. In this particular case, we also have the $40,000 two weddings at 66 modeled into the program. Remember, we also talked about them selling a home, paying rent. It's coming in right here. And we talked about at 90 years old, their spending jumps from this amount to now this amount because they've got assisted living. So we've modeled in all of the different expense line items. This is critical to making sure we have as accurate a projection as possible. So what does this projection look like? In this particular case, they make it all the way to 95, and this is one of the classic, they could sit back and say, this is perfect. We've as per the book, they've died with zero. They've enjoyed their lifestyle. They have an amazing retirement, and they don't have any money left over. Many individuals might say it's ideal, but most individuals say probably not ideal. I don't have my cushion. Maybe I want to leave money to my next generation. But ultimately, most Canadians, you wouldn't want to go through a retirement with this. So now what we're going to do is they die with zero. Here's a little bit of what's happening. This is showing the spending of the retirement. The RSPs are depleting over time. The solid blue is the house. It's staying stable. Net of inflation, we grow a house at 2% inflation. At this particular point, the house was sold. The money then went into a non-reg and was depleted over the next 15 years. Again, with the outcome here being they make it just barely all the way through retirement. Probably not ideal. No cushion, no safety net, and no inheritance for the kids. So we're going to test lever 3 here, delayed retirement. So delayed retirement is probably one of the most powerful levers that all Canadians have access to. In this case, we're asking them, we're looking at this and saying, let's delay retirement possibly up to 65. What does that mean? The first line going down here is that initial projection. The second line going up is the one we're looking at right now. They have delayed their retirement to 65, so that means they're adding money each year to their RSPs, and they're not, more importantly, depleting their assets. So the delayed retirement, the high of their portfolio value, starts at 65. You can see already there's a major gap here. And that gap allows them to protect themselves all the way to the very end. It gives them a surplus. It gives them a cushion. It allows them to get by any negative what-if scenarios that might pop up. But essentially, if we line up the two projections side by side, For Albert and Susanna, we end up with scenario 1, retire at 60, just making it with a little bit of a negative amount. Scenario 2, there's $1 million of today's dollars, so that's real dollars, after tax, after inflation. That $1 million sounds like a lot, but that $1 million is enough to add sometimes the protection that many individuals want, the protection to allow increased spending in go-go years, allow for any coverage of any spending surprises that pop up, any unexpected spending that pops up, poor market returns for whatever reason, sequence of return risk, which is a risk talking about if you retire and then you're faced with a series of poor market returns, but you're depleting. That's a very different outlook than if the portfolio grows while you're retiring initially. So this surplus allows for a variety of cushion to occur. So what can go wrong? We're going to go into one of the last two areas of this webinar. What could go wrong with a projection? What could go wrong with a projection? The number one thing that can go wrong with a projection is that individuals underestimate their spending. It's a critical area. That's why we spent a lot of time on it today. They underestimate calculating this area. We see it. We used to see it a lot. Now we are much more proactive in letting clients know that this can happen. But we used to see a lot when clients used to come in and say, "Well, I need extra money to do this. I need extra money to do that," and say, "Well, but we didn't really put that in the projection." And so we all learned that these things need to really be flushed out. So that's problem number one: underestimating your spending, underestimating the gifting that you want to do, underestimating some of the extra support you might wish to give your family members. Problem number two is overestimating. So the first one was underestimating. Now we were into overestimating the long-term returns in your portfolios, in your investment accounts. Stocks, if inflation is at 2%, stocks most likely potentially between 6 and 7%. Some individuals are using lower stock returns because we've had such great previous returns. But let's think 6 or 7, so a real return of between 4 and 5%. And then fixed income at 3 or 4%. Again, with inflation at 2, that's a real return at maybe 1, maybe 1.5. All this is gross of management fees. So what you really need to do after that is then reduce that return by the management fee. Because most individuals need some form of advice all the way through retirement, some oversight in portfolio management service. The services cost money. They need to be added in. We need to work with net returns. So that's a major problem, individuals overestimating returns. Finally, the last problem is individuals don't do what-if scenarios. They don't stress test portfolios. They don't stress test and add these, if this happens in my life, am I okay? These are all unique. Again, this is part of everyone's unique puzzle. This is why we framed this entire webinar around the puzzle. Everybody has a unique puzzle around their what-if scenarios. It's important to identify what does your unique puzzle piece look like. And the stress testing advisors can pretty much come up with that in terms of providing a variety of stress-tested environments. But the what-if scenarios are really unique, and it's important you think about. So, in conclusion, we've built this webinar around this idea that everyone has a unique retirement puzzle. We really highly encourage everybody, step number one, use the framework. Use the 6-piece framework as a way to think about how you think about your retirement. Step number 2, take the time to identify each and every piece of your puzzle. It's unique to you. It's unique to you and your family. Take the time to figure out what those puzzle pieces look like. Step number 3, take the time to solve your puzzle. Put those pieces of puzzle into a projection, work through all of your different scenarios, and solve your puzzle. If you solve your puzzle, what does it do? If you work on your puzzle, what does it do? To me, it brings tremendous clarity, tremendous peace of mind, and it helps each and every person become aware and empowers them to think about, if I need to make any decisions, you need to know about that sooner rather than later, and then you need to make smart decisions. Solving the puzzle allows you to do all these different things. So in conclusion, I'd like to take the time to thank you for joining us in today's webinars. Here's a couple next steps for you. Option one is simply to take the presentation that's available on the webinar, download it. We will be sending you after the webinar a copy of the presentation. Take the time to start working on your puzzle. Other things you could do. We've built a podcast series called The Empowered Investor. In The Empowered Investor, we already have possibly 10 specific podcasts designed for pre-retirees. How to think about your retirement. What are the myths you need to be aware of? What's lifestyle creep and why it's important? How to calculate your spending during your retirement. There's specific podcasts just on that. Please tune in, and we hope you find them informative. Option two, book a discovery meeting with our team. So the discovery meeting process looks like this. If you connect, we will set up a discovery meeting with one of our advisors. You will have a chance to share your story. You'll have a chance to share your objectives, and we will start identifying the pieces of your puzzle right away in that discovery meeting. If there's a really good basis to maybe go to the next level, we go to the next level. The next level is a proposal meeting. We will actually, in that proposal meeting, not only show you how we will manage portfolios, not only show you how our services work, we will actually build out a projection for you. We will try to give you the most amount of clarity upfront possible, and we'll show you how the system works. We'll show you how your puzzle works and how the projections would work for you. After that proposal, and only after that proposal, will we ask you to see if you feel there's a fit and if you wish to move forward as a client of our firm. And it's these different steps that I feel are so powerful and so important. And the two types of pre-retirees that we like to work with, one would be in the power years, individuals between the age of 40 and 50, highest income earning years, peak years. They also have the most amount of competing interests, perhaps raising a family, career, and trying to figure out what to spend during those years versus what to save for the future. This service of reviewing your puzzle and coming up with really solid and strong projections is an incredible process to go through. The second area of individuals that we feel are where there's a great fit are pre-retirees, maybe between the age of 50 and 60. You've done all the heavy lifting. You've done most of the saving. You can see retirement or that time of independence right before you, but you really want to make sure you have a second opinion. You really want to make sure that you're doing everything possible. And if there's any last minute decisions that need to be made, you want to know about this now. You don't want to know about this too late. So that's really the second group that we love to work with and we feel is a great fit. And so this is the last slide I'm going to show you. It's a slide of our firm. Tulett Matthews and Associates has been in business for over 30 years now. I'm super proud of where we are and where we're going. When advisors are aging and aging out, we've built a team that's young, dynamic, and ready to take on all retirees for the next 30 years. Our group consists of 4 lead advisors, 4 lead managers, all of which are shareholders of the firm. Ruben, Marcelo, Lawrence, and Jackson, supported by an entire firm on portfolio management, tax planning. It's been a wonderful experience. I've been involved in mentoring. I've been involved in helping. I'm thrilled that I had a chance to do today's webinar, but essentially we're in the business of helping as many Canadians as possible, and we look forward to potentially hearing from you and working from you. In the meantime, I'd like to thank you so much for tuning into today's webinar, and we really hope that you found the information informative.